Hi, my name's Leon Rowe, currency trader and trading coach at trading180.com, and in this video I'm going to be answering a very common question I get, which is, can you trade supply and demand zones on day trading time frames? So can I plot, is the question, can I plot my supply zones on 1 hour, 15-minute, 5-minute, time frames, and will they work? And really the answer is, drum roll please, yes. But there is a big but. There is some things that you need to consider when you're looking at intraday timeframes. One of them is pretty much basically the time frame significance. So intraday traders will generally observe daily time frame levels, right? And daily time frame traders do not really observe intraday charts and levels because they see it as noise. So you've got to think about the Forex market and how much supply and demand goes through or is transacted on a price chart throughout a certain time frame. So on a daily, it's obviously going to be around a lot more supply and demand is going to go through the market and is printed in the market and is moving the market than, for example, a 5-minute chart, right? So it's obvious that a daily time frame is going to have way more significance, going to be a lot more powerful when it comes to plotting the zone and understanding why there was demand or supply there. The markets are also manipulated, a lot more manipulated on lower time frames. So what you see on the lower time frames is, this kind of gets into advanced stuff, but things like the financial institutions avoiding slippage and basically stop hunting and searching for liquidity. Yeah. So, the higher time frames are a lot more significant, and really to kind of illustrate, the point is when you look at this price chart and you're looking at, for example, these demand zones, all you're getting is 5 minutes of demand. And I'm not showing this to basically show why this fails, but it's just to look at, because traders will look at, rally-based drop-based rally. By the way, I don't subscribe to that theory. And they would plot their levels of, demand, for example, on a 5-minute chart, and then wonder why it doesn't work. And I'm not saying it doesn't, whether it does or it doesn't. There are certain zones, and I'm going to maybe show you at the end, if I was trading these supply and demand zones on a lower time frame, which ones I would actually look to trade. But you've only got 5 minutes of demand coming into the market. This may represent only maybe 10, 15, 20 pips. This may only represent maybe about 20, 30 pips. Why is that significant when you're looking at an exchange rate? Why is that significant? Why is that 5 minute rally-based rally demand zone significant in any way, shape or form? So again, looking at the bigger picture and understanding the bigger picture, is really what you should, I can't say that you should, but what I look at. And it's a lot more significant the higher the dailies and the weeklies. And I understand why traders look for intraday, because they want a lot more trades. But one of the things that we need to do, right, is define supply and demand on a candlestick price chart. So I spoke about rally-based drop-based rally, and that doesn't really tell me much, in a sense that, and believe me, I've watched the videos. What makes sense to me is this, right, is higher highs and higher lows, HHHL, higher highs, higher lows, and lower highs and lower lows. So let's, for example, define this. So what we're looking for is strong area of demand. Now this is a price chart, and this is obviously price, and this is time. Then, and this was, for example, 0, right? It started at absolute 0. Then we've definitely got demand here. 100% got demand here, and there was strong demand because buyers came into the market and pushing prices up. Then all of a sudden, demand starts to wane. This now becomes an expensive area once prices start to pull back. Yeah, there's no really demand at that price, which price may be something like 10, for example. Yeah, whatever it is, £10, $10, etc. Right? So this now becomes an expensive area because buyers, are no longer willing to push prices higher. This was a bargain area. Yeah, strong demand came in because it's proven by what price did at that price zone. Now, once we're in a between a bargain area and an expensive area, we know that this is obviously a strong area of demand. Now, if prices make a new high like that and they push past this previous expensive price, then this has to be a bargain again. This has to be a bargain because buyers were buying and buying and buying up until the point where there was, £10 was previously, expensive, but buyers still decided that this is an absolute bargain, or still a bargain anyway, and continued to buy and push prices higher. So if prices were a bargain here past this expensive here area and this expensive price, what do you think this is? This is Black Friday. This is January sales, for example. This is 80-90% off, if you know what I mean. And it's just how it goes, right? So higher highs and higher lows, and you have to wait for price to prove the higher high. Yeah. So this movement here, is what we define. This area here is defined as where demand is. This is demand. This is the strongest area of demand. Whereas if you have, for example, a move that does something like this, right? High, low, for example, I say low, but an expensive area, bargain area, expensive area, and then you get a bit of demand, but it doesn't really pull, it doesn't really go past that expensive area. It starts to, drift away, etc. Then could this be considered demand? Of course it's demand, but is it a strong area of demand? That's the question. This is the question. Is it a strong area of demand? And my answer would be, well, no, it can't be strong. It can't be that strong because buyers were still not willing to buy at that price zone. Yeah, this was still considered expensive. And when prices go into a ranging market, that's pretty much what expensive is. Yeah. Or cheap is. Cheap or a bargain price. Yeah. Proven by the market. And the same thing for lower highs and lower lows. It's exactly the same thing. Lower highs, lower lows are what we would consider areas of supply. Yeah, and the strongest areas of supply are when prices, break through a potential area of demand. Yeah, so it's basically the same exact principles. Now, how's that represented on a price chart? Now, this is represented on a price chart. We're doing at higher highs, higher lows. From a daily time frame perspective, what you're looking at is that move there, and you're looking for a bearish candle. And then you're looking for another bullish candlestick. And as you guys can see, this represents higher highs and higher lows. So high, low, and then a new high. So this area now becomes an area of demand at some point. Yeah. So this would be demand. Now on a lower time frame. Yeah, so this is obviously, if we go down to the hourly time frame, this whole move up would be made up of 24 bullish and bearish candles, obviously more bullish candles than bearish candles, making obviously new highs, or at least a move up, etc. And then you've got obviously this pullback would be more bearish candles than bullish candles and vice versa. So every intraday time frame candlesticks, whether it's the hourly, 15-minute, 5-minute, this on a daily would represent a trend. Yeah. So when we're looking at pullbacks and using daily time frames for our entries, as far as understanding why we're looking at daily zones, I'm taking advantage of pretty much the daily time frame takes advantage of all intraday trending environments. And as we know, this has to be, the area that we want to get long on. Yeah. Now imagine this. Yeah. Now this is now let's say for example, this isn't a daily time frame. This is now the 1 hour time frame. Yeah, it's the 1 hour. So if we're now going down into maybe something like the 5 minute time frames, right, or the 1 minute time frame, for example, you're going to have 60 candles, yeah, within this hourly time frame here. Yeah, or if you're doing a 10-minute time frame, then obviously you're going to have 6 candles, etc. Right? They're going to make up this move up, this move down, this move up. Right? Now, again, the question you have to ask yourself is 6 10-minute candles, yeah, 6 10-minute candles within this hourly time frame enough? And 6 here, and then 6 here, and then 6 here. Is that enough to make up, any kind of major and significant demand? How much demand is going through and being made up? So 6 10-minute candles, yeah, 4, 5, 6, however it is done. That for me is not significant enough for a trend. Yeah, like I said, hourly time frame traders, you have to look down on the lower time frames in order to understand, how much supply or demand is being produced volume wise within this higher low. Whereas on a daily time frame, you know that you've got the whole day's volume. You've got all the 1 hour traders, all the 4 hour traders, all the 10-minute traders, etc. You've got the whole day. So this is why this is, the higher time frames are more significant and more powerful when it comes to understanding time frames. So obviously the lower that you go, and let's go back to, for example, the previous slide. Yeah, when we look at the bit too far. Yeah, when we go back to this and we look at the euro dollar on a 5 minute time frame, yeah, what you're actually seeing in this area, and if that is as traders put it, drop based rallies, or I should say rally based rally, etc. Right, which I don't subscribe to that method of thinking. But if this is higher highs and higher lows, yeah, and this is a 5 minute chart, is there any wonder why something like this doesn't work out? Because all you've really got on a micro trend level are just 1 minute traders. If this was an hourly time frame, it would probably be the same thing. Everybody looks at daily time frame charts. Not daily time frame traders, yeah, are not looking at, and weekly time frame traders, the higher time frame traders, are not looking at the lower time frames. They just look at that as noise and mess, and you're just not going to get the volume that you do. Now, is there a way to trade lower time frames? And zones, and if I was trading lower time frame zones, these two ways of trading lower time frame zones are the only way that I would. Right, and I'm going to give you guys something to have a look at. Right, so let's look at, for example, demand zones. So let's go create a demand zone. Yeah, there, and then let's say, for example, we've got strong demand right there. Yeah, now this becomes our demand zone right there. Now this is represented, for example, on a daily time frame chart. So this is the 1 day. Now, if you get something similar to this on, for example, a 1 hour time frame chart, where you've got move down, and then there, 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 and that obviously is demand. Something similar, doesn't necessarily have to be the same. It's rarely the same, but something where you can look to see that there is a demand zone and it's at an area or the lowest area of the daily demand zone, and then you zoom in and then you see something like that that creates obviously this whole area here, I should say, this hourly demand zone. Yeah, and this is the swing low here, and this represents a swing low here. Then I would say that is an area that potentially I would trade if I were trading, 1 hour demand zones or even supply zones. Yeah, it's because the lowest area here, I mean, remember this is price and time. If we're looking at, understanding price, let me actually draw it in black. Yeah, so we've got price here. The strongest area of demand is going to be where traders were buying in such volume that it pushed prices here, up above a previously potentially expensive area. So it only makes sense that, and again, this is being price, if this represents 5 and this represents 4, and this represents maybe 6, etc. Yeah, where is the best place to buy if prices come back? Are you going to be buying at the top of the zone, or you want to be buying at the bottom of the zone? I'm not saying that prices are always going to reach there, because prices don't always reach there, if you know what I mean. But if I were to trade this daily zone, as far as zoom in and look for hourly zones, this hourly zone here would have to be the absolute low of the daily zone, and then I'm looking for hourly zones before looking at obviously prices to come back within that hourly zone, and then there, because you're buying at potentially the strongest area of demand. If you don't want to necessarily, because this could represent, for example, this whole area could represent 50 pips, for example, on the daily, or 100 pips, whereas this 1 hour zone could maybe represent maybe, I don't know, 15 pips, for example. Yeah, and I know traders like cute entries, you want smaller risk and massive rewards. And like I said, I'm not saying that you can't take these zones. All I'm saying is that marry it with the with the strongest area within this daily demand zone, and then what you want to do is go down into something like the hourly, and then look for those demand zones, and then look to trade that if prices do come down into that area, because there's pros and cons of everything. Prices may come to the top of this area here, yeah, and then bounce off here, and you may never get an entry at the absolute lows. So again, there's pros and cons with everything. The second thing would be if the hourly zone that you're looking at, or intraday zone, it could be a 15-minute, it could be a 10-minute, 5-minute. If that zone was created by a news event, yeah. So you're looking at, say for example, this is a 15-minute chart, and then you see that the zone is created, and you go back in time and you look at, for example, FOREX Factory, and you think to yourself, oh, that was created by some news that was GDP, FOMC, jobs report, etc. Right, and you get this created via a massive and an important and impactful news event. Then I would trade this zone. If I look back, right, and then I see a demand zone or a supply zone, and it wasn't created by really anything other than potential profit taking, then that's not an area that I would ever look for or to trade any kind of intraday zones. It has to be, an area that traders were definitely trading fundamentals, and the fundamentals were the cause of the move. And if you want to actually go back You know, you can go back to Forex Factory, for example, and just go back in the calendar and look for, you know, marry it with, for example, some price action. Go back to the day and then see when the price was caused, and then say, all right, then, well, this was caused by this or that or whatever it is, and then you go back to your demand zone and say, all right, then that's what we want to trade. So intraday highs and lows, which basically marries up with the daily swings and highs and lows if I'm trading any intraday time frames, and also news as well. If there is news that cause that supply or cause that demand zone, then that's where I would be trading any intraday supply and demand zones. So never confuse activity with accomplishment. And what I mean by that is, just because you get more trades on a lower time frame doesn't mean that you're going to be accomplishing more than anybody who is taking daily or weekly zones. As we know, daily and weekly zones are the most significant and more high probability than your lower time frames. So with that being said, no one is better than the other, but just understand that each higher time frame and lower time frame has pros and cons. Higher time frames, you may have to wait a little bit more for a trade, but you know it's going to be more of a significant zone. And obviously on the lower time frames, you're going to have supply and demand zones everywhere, but you're never going to know which one is really that significant. And I say never, but it's going to be harder to identify the more significant zones, which should be a lot easier now after watching this video. So if you do have any questions, just email me at info@trading180.com. Also as well, supply and demand isn't just about technicals, it's about the fundamental analysis and understanding value and why the banks trade and identify value, and what the reason why the banks trade as they do. Is really an integral part to supply and demand, and if you want to watch that course, it's absolutely free. The link is in the description box below. Trading 180, I think / fundamental and sentiment analysis or something like that. Anyway, it's in the description box below. All right guys, well, take care, and until the next video.